Hello options traders, welcome back everyone and happy Friday. I thought today would be a good day to talk a little bit about log charts. And the reason is I've heard a lot of people on the internet recently and in a lot of the chat rooms and webinars and things I've been doing talking about how unstable the market is becoming. And they'll say, well, it's obvious that we're due for a sell-off. And I'll say, well, how do you know that? And they say, well, it's very obvious. Just take a look at the chart. You can see that we've been into this massive acceleration in the past few years, and we're obviously overbought and we're due for a major sell-off. Well, it's an easy misperception to fall into, and this is where log charts can help. So, for example, here's a chart of the spiders, the S&P 500 from 1950 to today, and this is what a lot of the people are pointing to. In fact, I just saw a trader not too long ago who posted a video very much like this. And he said you can see how slow and steady the market was climbing here. And then once we got into the internet boom, starting in the mid-90s, we went into this acceleration period. And they were saying, you can just tell that we're getting so overbought. In fact, it looks like if this chart continues at the same trend, it's going to start folding over backwards on itself. It's like a rocket ship getting launched into the stratosphere, and just because of this visual graph here, they think that it's a dead giveaway that we are overbought. And then they further go on to say, well, you can see that the average trend was through here, so when we pull back, we're going to be coming way back down into here. And these are easy misperceptions to fall into, and this is one of the reasons why you should take a look at log charts. So to make the point, let's take a look at a hypothetical stock. This was done in Excel, and let's say that this was our stock. Would you say that this is unstable? And most traders would say, no, this is exactly what a good, steady performing stock should look like. Just a nice, steady uptrend. Okay, well, let's hold that thought. Let's go to another hypothetical stock. What about this one? Is this unstable? And they say, oh yeah, this is exactly what I'm talking about with the S&P 500. You can see it was very steady here in the early years and then recently has been shooting off into the stratosphere. And we're definitely going to be due for a major painful correction. Well, these are easy illusions to fall into, and they're just simply misperceptions from not understanding that stock prices move in percents. So if we have shares performing equally well, they should all move in the same percentage. So let's say that we have three companies all doing equally well and that they all rise 10%. Well, the first stock might be a $10 stock, and that means it's going to rise to $11 or just by one single dollar. If the second stock is a $100 stock, it's going to rise to $110, an increase of $10. And if the third stock is a $1,000 stock, we're going to see it rise to $1,100 or an increase of $100. So notice that even though all three of these stocks performed exactly the same, the dollar differences are very different. We're comparing $1 to $10 to $100. So if we just looked at that, not the percentages, but just those dollar changes, it would be easy to think that the $1,000 stock outperformed them all because it rose $100. But if you really think about it, you would see that that's just simply not true. So if we go back to our hypothetical stock here, what I did is I made this one rise by a steady $10 per year. And most of the default charts that you see on softwares and charting platforms are using what's called an arithmetic scale, which is what we're looking at here. And what that means is that if you notice the distances between each of these horizontal lines here, that the distances are the same dollar amounts. So starting from the bottom here, 0 to 50 is an increase of $50. From 50 to 100 is an increase of $50. 100 to 150, again, each of these horizontal rows right here is an increase of $50. But remember, stock prices don't move by a steady dollar amount per year. They move in percentages. So let's take a look at this same chart in percentages. When the stock moved from 50 to 100, that was a 100% increase in the stock's price. But when it moved from 100 to 150, that was only a 50% increase. Then when it moved from 150 to 200, that's only a 33% increase. And then from 200 to 250, is a 25% increase. 250 to 300 is a 20% increase, and so on. So even though visually it might look like this stock is moving along at a steady rate, in terms of performance, it's actually falling because those percentage changes are decreasing each year. So rather than looking at a chart like this, where each of these rows is a steady increase in a fixed dollar amount, like here we're increasing by $50 each time, let's change it to a log scale. In a log scale, instead of increasing by a fixed dollar amount, increases by a fixed multiplier or a fixed multiple each time. So take a look here. Even though on the surface it might look like the same scale, the spacings in these horizontal rows here are all the same, but notice that we're starting with 1 and then moving to 10, and then from 10 to 100, and then from 100 to 1,000, 1,000 to 10,000. See, the distance between these is not the same, but the percentages are. So take a look here. As I move from a price of 10 to 100, that's an increase of a factor of 10, or a tenfold increase. As I moved from a price of 100 to 1,000, it looks like a big jump, but it's still the same tenfold increase. Then when the stock rose from 1,000 to 10,000, it's still a tenfold increase. So again, the percentages are the same, not the dollar changes. See, from 1 to 10, we only increase by 9 units, but from 10 to 100, we increase by 90 units. So it's really just a different look at the data. So let's go back to the stock that everybody thought was unstable just by looking at it visually. And what I did to create this chart is I made it rise by 10% per year. Not $10 per year, but 10% per year. So yeah, eventually you're going to hit a point where you're going to get this exponential increase. But it's still just a steady increase of 10% per year. So again, the reason for this misperception of looking like something changed out in this period of time here and really sent this stock into orbit, it's because we are going into just exponential increases. And we're looking at it on what's called an arithmetic scale. I'm going from 20,000 to 40,000, an increase of 20,000 units. Same here, from 40 to 60, from 60 to 80, 80 to 100. See, the percentages are not the same. So let's take this same chart here and put it on a log scale. And if we do that, this is what it looks like. See, the log scale shows us more of what it would feel like moving through time in this stock. It was just a steady 10% increase per year. It's just because as you start looking over decades of data, yes, a 10% increase becomes a much bigger dollar amount over time. But that's just a misperception. So in this case, we might look at it and say, hey, what I thought was an unstable stock price is really exactly what I should expect from a company that is performing equally well across time. Now, just for comparison, let's go back to the chart that everybody thought was moving in a steady fashion that was increasing $10 per year. And of course, it created a straight line like this on an arithmetic scale. But what happens if we put it on a log scale? Now we see the truth. You can see that in the early years, it was actually performing very, very well. But then as time went on, the slope here is starting to flatten out. And that's because, as we saw, those percentages are declining. So very different look here. The stock that you thought was doing really well and was steady is actually declining. And the stock that looked like it was being sent into orbit is really just on a steady path. So let's go back to our S&P 500 from 1950 to today. Again, notice that we are in an arithmetic scale here. And that's because each of these rows here, I'm going from 0 to 500, 500 to 1,000 to 1,500. Each row is increasing by a steady 500, not a steady percent. So let's take this same chart and put it on a log scale. And when we do, it starts to straighten out. It doesn't look like it's that unstable rocket ship that's getting launched into orbit. And in fact, if we connect the far left side of the graph to the far right, it's what we would call the average rate of return. and it's just about 7.7% or about 8% per year, pretty much what we would expect. Now it is true, in this period right here, starting in the mid-90s, you can see this big blue bubble where the stock prices were certainly doing much higher than average. And this was the tech boom. This is the crash of 2000 right in here. This dip down here was the financial crisis of 07-08, and yes, you can see that it was definitely below average. So you can see that since about 08, we've just been on a steady path, even though it looks like we're becoming very unstable. So again, those are just misperceptions. So when traders use log charts, it can help you to see stock prices as they truly move. So how can you set a log chart? Well, it depends on your broker, but they all pretty much allow you to do it. So let's go over to the thinkorswim platform and see how to set a log scale. So here's thinkorswim, and you can see this is the S&P 500. It won't let me go back as far as I did in Excel, but we're coming back here to the mid-90s, and we can at least start to see this kind of this parabolic move, at least the way that it looks to most traders. So how can we change this to a log scale? Well, again, most of your brokers will allow you to do this, and they're going to do it in different ways. But for thinkorswim, you come up here to this cogwheel, and this allows you to set various settings. So right here on your price axis is where you can find it there. And if you look right over here, display, use a log scale. Just check that box, click apply and OK, and now we get a very different look at what we thought was an unstable price pattern, and we see that it just simply isn't. And that's one of the benefits of using a log scale. If you'd like to learn more about the art and science of options trading, please check out the Alpha Trader course and strategy lab at optionsatoz.com. Also, please join us on the Facebook trading group Options A to Z, and you can find a link in the description below.